the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares hovered above the flat line today as investors continue to digest the outlook for the US economy. Now, the Straits Times Index nudged 0.02% higher at about 2:20 p.m. Singapore time to 3,833 points, with a value turnover of 1.06 billion Sing dollars in the broader market. Now let's take you through the closing numbers. The STI ended further in the green, up 0.12% at 3,837 points. In terms of value turnover, we are looking at 1.77 billion Sing dollars. Gainers outnumbered losers 247 versus 236. Top advances for today we've got for you JMH USD, ST Engineering and City Developments. And top decliners we've got here DBS, UOB and PC Partner. Well, in terms of companies to watch, more on CDL because the property giant's executive chairman Kwek Leng Beng said in a statement last night that he will be discontinuing his lawsuit against his son Sherman Kwek as well as 6 other members of the CDL board. Now, elsewhere, from U.S. consumer prices increasing less than expected in February to what Trump's $1.4 trillion tariff threats mean for companies. We've got more international headlines in focus. And joining me on the line is David Chow, director at Azure Capital. David, you there?
Yes. Hi, Tian Tian.
Great to have you. And David, let's start with the U.S. this time around. U.S. consumer prices increased less than expected in February, but that improvement is likely temporary given the backdrop of Trump's tariff on imports. Now, if we go by the numbers, the CPI rose 0.2% in February after accelerating 0.5% in January. How far were the numbers to your expectations? That's one thing. And the second is, how far can we rely on the numbers given Trump's on-off tariff policies?
Right. Prior to the release, we had forecasted a figure of 0.27%. So this outcome actually beat our expectations. Which showed inflation was tamer as expected. But I think at least in February. However, we are not relieved at all as this piece of data certainly did not entail any tariffs, which is perhaps also the reason why didn't all the three U.S. indices close higher yesterday. Only 2 out of 3 actually closed higher. And I think it's still premature for the Fed to let down their guards as it may still raise interest rates again if inflation turns out to be hotter than expected as we progress throughout the year. And as we speak, S&P 500 futures are now down, and the Nasdaq futures are also down. It's not looking good again for risk sentiment. Any hope of relief from the CPI report yesterday, is starting to unravel again. And I think we have already seen signs of that happening in the U.S. trading yesterday, and I think just before they closed the Wall Street, I think they actually popped gains after the inflation numbers, but still managed to salvage a little bit higher, at least for the tech shares. So I think right now we are definitely setting up for a more defensive mood, going into the session ahead. And my worry is that the sell-off will again threaten to emerge and happen tonight and tomorrow, as Trump may just retaliate against EU counter tariffs.
Retaliate. Okay.
Retaliate, yes.
Yeah, okay. Back to the Singapore stock market as usual. David, how did the STI fare today? Any surprises when we look at the biggest movers and some of the companies posting earnings? Del Monte, for one thing, reported net loss of $35.9 million USD for third quarter ended January for them, widening from $29 million US seen in the corresponding period in the previous year. How concerning is this?
Okay, on the Singapore stock market, I think STI was quite fortunate not to be really caught out amid the negative sentiment that rapidly grew throughout the day and managed to close just 0.1% higher. So if you look at Del Monte's counter today, I think it closed low at 2 to 3%, and rightfully so, as the results they reported is certainly not pretty. inspiring. And amid falling financials, the overall financial picture is also not inspiring for the company as well. I mean, if you look at metrics such as, we are looking at it after the results were released, we're computing the metrics such as, return on capital employed, which is basically your earnings before interest and tax EBIT divided by, your total assets minus your current liabilities. Then this works out to about 1.4%, and that's a really low return. That's a really low return to us. So if we measure this against the broader, the food industry that Del Monte resides in, the broader food industry is actually about 8.9%. So this tells you, a lot on why the current share price stays as it is at current levels, and at the price of 0.07 cents, it's a penny stock price. And this alone, will have, investors staying on the sideline as they are not really comfortable to trade penny shares, for some of them.
And let's zoom in on another company. And this company saw its shares surge some 3% at the close today. City Developments Ltd, CDL. Why so? Its executive chairman, Kwek Leng Beng, said in a statement out, I believe last night, that he will be discontinuing his lawsuit against his son, Sherman Kwek, and 6 other members of the board. Now, the elder Kwek will continue in his role as executive chairman, and Sherman Kwek will remain as group CEO. More worthy of note is that all the current directors, including Jennifer Duong Yang and Wong Su-Yan, they'll remain on the board. Finally, some closure to this saga for now, but what's your take on the latest move by the elder Kwek?
Yes, existing investors of this CDL should welcome the bounce today, and rightfully so, since there won't be any lingering legal issues around for now. So I think as I was looking at the counter throughout the day, I think have a bounce of as high as 6% before powering down to about 3%. And this level, I think this current share price level will actually put the share price right back to where it was before the saga. And this current level, ironically, also sees CDL back to its trading range established in December last year. I mean, fundamentally, there's no change to the company's fundamentals. Operationally, we have seen that CDL Singapore portfolio continues to perform strongly, but overseas market conditions are somewhat stabilizing. Their main hospitality segment growth, I think, is expected to normalize after a strong performance of the last year, and gearing is still, of course, on the high side, as I've said, of 2 weeks ago, and more divestments are really needed to improve profitability. So if you ask me, as a neutral investor, I think a major shade up could potentially unlock value. And when this CDL saga happened weeks ago, we re-examined our financial models only to see that CDL was trading at a very cheap discount of about more than 60% to our net asset value price. However, because of these legal issues, we have conferred a higher discount due to corporate governance concerns, and I'm sure other houses in the market will do so likewise. So, with that being said, CDL share price is likely to remain under pressure, even though it even though it bounced up today. We really see a complete revamp of the board and strategy with additional safeguard in place, or a potential breakout of business segments are catalysts to its share price for now.
I see. Well, if you're just tuning in, we're in conversation with David Chow, director at Azure Capital. And David, across the region, Hong Kong Stock Exchange, it is reportedly discussing options to lower the threshold for investors to buy some of the city's most expensive stocks to stock trading. And this is, of course, according to people familiar with the matter. If it is truly implemented, David, what do you think is the impact on regional investors, and what can we do also in Singapore to drive up trading activity on the local bourse?
I think we look at this from multiple fronts, and one of which will actually be on fund flows. So if you have noticed, for us at least, this came at the back of southbound capital flowing to Hong Kong from China at the fastest pace in 4 years, and this flow from China actually make up a turnover of about 30% of total turnover based on our tracking of fund flows. So with this decision to perhaps lower the prices of to trade the city's most expensive stocks, we think that the exchange is still trying to attract more funds from China, as we also note that rising demand for offshore asset allocations and portfolio adjustments by funds qualified under the QD II has been the key driver of accelerating southbound capital flow since February, and even as far back as of fourth quarter last year, offshore offshore stocks, including the Hong Kong stocks and ADRs, only account for about 13% of Chinese unit trust stock portfolios. And we believe the aggregate exposure to offshore stocks by Chinese investors could be even lower at about 10% or below, versus I think that of the US and Japanese investors of about 20 and 50% respectively. And on another front, we also noted an increase in IPO activities in the UK Hong Kong market, spurred by regulatory tailwinds that could prove to be a bumper in the IPO market this year for the Hong Kong market. So you can see tailwinds such as mainland company facing fewer barriers to raise funds in Hong Kong, and we see weakening interest to list in the US due to obvious reasons because of tensions for both countries. So this could further tip the favor for global investors to power into the Hong Kong stock market. Not to mention valuations of Hong Kong markets are more attractive versus that of the Western world. So going back to how SGS could cope with this, I think at this juncture, we have tons of market professionals who have come on air, to discuss, what should be done. And Terence and I have spoken on this at least twice. So with all the talks, we need actions now. We need the market review committee to either implement some of the measures discussed or measures which they think are ideal to really spur the local market.
And further away, David, let's talk about something fun. Sephora CEO Gilmore, he has taken personal charge of its operations in China, which is the latest management shift at the LVMH-owned cosmetics retailer, because it's struggling to win over consumers in the world's second largest economy. What's your take on the matter then?
I think not only LVMH, but as far as I'm concerned, other luxury brands are hoping that they can, now convince shoppers, including those in the biggest market, China, to splurge, on their leather handbags, accessories, fashion apparel, jewelry, watches, as they were before the pandemic hit a few years ago. And I think as far as we're concerned, for over a decade, global luxury goods sales actually buoyed by soaring revenues and margins from an increasingly rich, China middle income, really helped to grow the bottom lines for a lot of these big global brand owners. And previously, robust economic growth in China has also contributed to improving living standards. The creation of new wealth, spurred by rising property prices, have also driven luxury consumption in China. Which previously grow at the 9% compounded annual pace compared to just I think 4% growth in global sales. So in the aftermath of the pandemic, as we all know, China property prices has been falling. The confidence of China consumers has been hit, and many of these luxury sector management, as they report on their earnings results and from their earnings, transcript, we have seen that they have been, trying to console investors by saying that as they see China's, kicking in fiscal stimulus, there will be clearer signs of recovery as soon as maybe in the second half of this year. But this actually coincides with Trump's preparation to slap tariffs on imported goods. So with that being said, we are really adopting a wait and see to see how far China's economy can recover before we start to see solid recovery for these brands.
Yeah. And finally, before we let you go, David, companies around the world appear to be looking for cover from U.S. President Donald Trump's frenzied tariff barrage. Now, Ozempic maker Novo Nordisk, it is planning to make more of its medicines for the U.S. market and the country. Boeing risks a gummed-up supply chain, and Chinese online retailer Shein Group is offering incentives to its top apparel providers to set up new production capacity in Vietnam. Any guesses as to how global supply chains will shift? Are we getting any indication at this point, or is it too early to tell because firms are still trying to scramble for direction?
Off the top of my head, I think it's best to cite some figures from surveys. And I came across a survey commissioned by logistic company DP World, I think late in January this year. I think they see roughly about 40% of businesses planning to increase their sourcing from the US in order to manage higher import costs. And in general, I think that survey, they actually surveyed more than 3,500 supply chain executives across the companies across the globe on what they're seeking to do. And I think 30+% said that they plan to adjust their supply chain network and strategies in the coming year. And I think another 30+% said that they are looking at reducing internal costs, while 20% are preparing to expand their manufacturing capacity in the US. I guess as a whole, businesses are not, retreating from international trade, but are stepping up to the challenge. And I think I could also see that from our own research that companies are also focusing on building out, so-called dual supply chain, with one linked to China and another to a separate production hub such as Thailand or Vietnam. But with this being said, they are just hoping that Trump won't impose tariff on starting to impose tariffs on Southeast Asia. Because if that's the case, then I guess we are looking at a worsening business sentiment. So as we continue to see Trump's trade policies take hold, I guess businesses will still be faced with the choice between diversifying their supply chain or building up inventories, to get ahead of tariffs. And I think with that being said, businesses with export business have by now formulated some sort of a game plan, so there won't be and shouldn't be, hopefully, any negative shocks from tariffs alone.
I see. Lots to watch as usual. Hopefully nothing too much to watch this weekend as we try to wind down. Thanks so much for the insights, David. That was David Chow, Director at Azure Capital, and thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.